Hey, Renter Retires, it's Adam Schroeder here with another episode, joined today by Zach Lemaster, the founder and CEO of Rent to Retirement. And you're going to notice that once again, we do not have a guest because y'all ask for it, we answer. Because there's a lot of stuff going on in the real estate world with all of the people guessing what the Fed's going to do and waiting for the Fed to do something. But the fact of the matter is, we're all just waiting and hoping and kind of guessing what's going to happen next. So we wanted to talk about the real world and what's actually happening and what people are actually doing. And that is one of the big things we wanted to get into was new home construction starts. Now, obviously, this is not something that should be too shocking to people. But the fact of the matter is right now, new home construction has dropped all the way to its lowest levels since May of 2020. Now, if you'll remember May of 2020, it dropped down to 900,000 because nobody was allowed to start anything. But we have dropped all the way down to, I believe the number is 1.24 million homes a year annual pace. That sounds like a lot of homes. We've averaged 1.5 to 1.6 million homes. They've estimated that we need something like 2 million home starts a year to try to catch up with the demand. Because remember, the studies they've done also show we're about, what was it, Zach, 5 or 6 or 7 million?
Seven and a half.
Yeah, million homes behind. So what do we do? What's going to happen? So we wanted to dive into that a little bit today to just talk about why that is both important and not important. So let's get into it. So 1.24 million means that this year will probably, if it keeps up, obviously, right, Zach? It's not a big surprise that with interest rates higher, builders are building less, right?
Yeah, I mean, the big thing is that let's break this down for a moment of what this actually means for the average investor. And to your point, Adam, I think the big picture is that when money is more expensive, it affects everything in the economy, right? Builders have to take out construction loans, and construction loans are high-risk loans for banks. And that means they charge appropriately with their interest rates. It's significantly higher on construction debt for an interest rate than it is for a long-term loan because there's simply more risk to the bank. And so that means money is more expensive for builders. And also on the back end, sales have been slower, right? The buying market on the retail side, because that's what a lot of these statistics mainly focus on as retail buyers. We know also with higher interest rates, there's just less transactions happening. And so builders are trying to anticipate this and starting less homes. Now, this is not a good thing. This is a bad thing because we have an affordability crisis in the U.S., and this makes it more difficult to dampen that with, providing more houses to the market, which is what we need. In previous years, if you look back, 15 years plus ago, we actually had an oversupply. But that has, since then, we have not had an oversupply of housing, and we've actually increased the deficit of housing. So we need more houses to be built. And, if interest rates, to your first point about interest rates being high, I mean, I'm not waiting. I'm the type of person who it's never served me well to just wait, partially because I'm impatient, but I've always tried to be a strategic investor about how do I make things happen? But the point is right now is that having less homes available, this is, and I'd like you to answer this first, Adam, how should we think about that from an investment standpoint? We can talk about global economics and what that means for the U.S. and housing and affordability, but what does that mean for an investor right now? Why should we even be paying attention to this statistic?
Yeah, so let's talk about the fact that this 1.24 million isn't hitting people right now, right? These are starts. So we're really going to see this crunch happen in anywhere between 4 and probably 7 or 8 months from now. But what's going to happen, what people are thinking, is that money's going to be cheaper then, right? And so there's going to be more buyers coming into the market and looking to do it. But guess what? If there's more buyers coming into the market and there's less homes available, more competition, likely going to drive prices up. So the question is, what do you do today, right? Because that's what we're always looking at is what do you do today? Well, today there is inventory out there. It's not completely abundant. It's not like, 2005, 2006, where we were building 2.2, 2.3 million homes a year. But we're still looking at a time where inventory's there. Money is more expensive, but still affordable. And like you said, the carrying costs for builders, if they finish a home and have to keep it on their books, it gets expensive, and it gets expensive fast. So they are offering incentives right now that they haven't offered for years, because they want to get these homes off their books, because, retail buyers aren't buying them now. But if they wait, if they wanted to carry them for 7-8 months, they can probably sell them on the retail market pretty easily. But they don't want to do that because that costs them tens of thousands of dollars. So what it's telling me, and what it's pointing at to me today, is look at the deals, make sure the deal makes sense today, but also remember, you're going to be able to get stuff now that you're not going to be able to get in 5, 6, 7 months from now. I mean, we've talked about it before and tried to hammer it home, but we need to hammer it home even more, that the deals that are going on now, you look at them, you're like, well, the interest rate's high. Well, guess what? When you look back 7, 8 months from now and think about kind of the coulda, woulda, shoulda, you're likely going to be wondering, well, I could have, I should have, but I didn't.
And that can always be the case, right? Hindsight 2020. But I think the reality is interest rates are kind of irrelevant right now, because there's builders that are so motivated to sell inventory that they've been sitting on, because their construction loans already have high interest rates, or they had to extend those and refinance those because they're holding their inventory, because there's not a lot of buying activity on the retail market, which means they're willing to buy down rates significantly. So it's interesting when we talk with investors that bring up interest rates and they're like, well, it's kind of high right now and we might want to wait until it's lower. My first response to that is, well, you can always refinance, right? This probably means there's a better buying opportunity. But in addition to that, there's builders that are sitting on inventory with high interest rate loans on their books that they need to recycle, right? They need to get their capital back out of it. They may need to actually refinance. We were speaking with one of our building partners in Alabama this morning, where they essentially, their line of credit on, I think, 24 of their builds is up in a month, and they're highly motivated to get those off their books. And so you kind of have to put yourself in the shoes of a builder, like why they're offering these type of incentives. And if you're a newer investor, this may not be apparent to you, because this is your first time kind of looking at these type of deals and seeing these incentives, which look attractive, but you just don't have the historical experience to understand that that's not normal. So just to back up for a second, review what you said so everyone can really grasp this. Essentially, right now, builders have, high interest debt. They likely have inventory sitting on their books longer than they would in a different buying cycle where there's more buyer activity. They've slowed their build starts because of that. That means less new construction is coming to market over the next 6 to 12 months and probably into the next 18 months. In addition to that, we're starting to see interest rates lower, which means from a retail standpoint, just a transactional standpoint, there's going to be more transaction volume. It's going to be a seller's market likely soon. And when it's a seller's market, builders don't have problems selling inventory. And the fact that they have less inventory in the future to sell means it's going to be more competitive for buyers out there. That means prices will go up and people will not have access to some of the incentives that they have right now. So all this being said, this is kind of what we're talking about today is that it's a unique time to make really big moves in new construction inventory that we have not had access to in the past, and that we likely will not have access to in a few months. And so it's really important, if you're thinking about buying new construction, right now is a unique opportunity. And we'll review exactly what we're talking about with some of these incentive structures. But man, it's a really unique buying opportunity. And we're seeing things that we've never seen before, right? In the 15 plus years that I've been investing, I've never heard of situations where you can get 10%, up to 10% of your down payment or of the property price, either reduced from the price or put back in your pocket. And also builders are buying rates down sometimes into the 4s. So it really doesn't matter what the Fed lowers the rate to. As we know, the rates will probably continue to lower over time, bring more buyers into the market. It doesn't matter if a rate goes from 7.5 to 6.5. If a builder is buying a rate down to 4.5 for you, and you have that on a 30-year fixed loan, right? That's going to increase cash flow. It's going to reduce your future loan costs, because you don't have to refinance that loan in the future. You don't have to reset that amortization scale, and you don't have to pay all these closing costs to refinance your loan because rates are lower. Like, people don't think about those things, but those are tangible returns on investments. But just to review kind of the incentives that we're seeing right now, and this is the reason why Rent to Retirement is a company we've made the decision to focus more on new construction homes. These are homes that are already built. Many of them are already leased, right? Not doing pre-construction, as we know that builders are stopping those. And it's a challenging market right now for construction, pre-construction and build-to-rent properties. We're focusing on homes that are already done, and many of them are already leased so they can cash flow day one. But we focused on new construction, one, because we believe it is a more quality investment than an older home and maybe a lower class neighborhood. We know that, simply put, you'll have with new construction longer term tenants, better quality tenants, more consistency in rents. You'll have significantly less maintenance on a house, even if it's fully rehabbed. Just new construction, you have builder warranties. You don't have to worry about capital expenditure items, your large ticket items for at least 10 years. These are brand new construction homes in growing areas because that's where builders are building. So these are areas that are going to position you to have a lot of upside over time, where a new construction property will just be a more predictable investment and position you very well. So that's why we like new construction. But especially right now, there's crazy incentives that I think are really, really attractive, again, that we haven't seen in the past and we likely won't have in a few months. These are things where builders basically, give you money to use however you want to. And this is part of the rent-to-retirement community. We're able to go in and actually negotiate with some of these builders to expand on those incentives beyond what an average investor, that's buying maybe 2-3 properties from a national builder. If you're buying as a group hundreds of houses like our community does, we're able to have more negotiation power, and you benefit from that. Some of these builders are offering anywhere from 7 to 10% of the home price. So on a $300,000 property, that could be $30,000 that you have the choice of how you want to use it. You can use it to buy the rate down a dramatic amount to cash flow better. You can have that be a price reduction where you come into immediate equity that will help with, if you're trying to burn new construction or refinance in the future and pull equity back out, that could help position you to do that quicker, especially as, we know that new construction appreciates better over time. Or you can simply get that kicked back to you at closing. If you're buying a $300,000 house, 20% of that is $60,000. You can get $30,000 of that back in your pocket with select inventory if that's what you want to do. That is huge. That's not normal. We've never seen things like that, right? So
let's repeat that. This is not normal.
So it's just look at that and really understand that this is not something you guys like. We are very excited about it. We're personally doing a lot of this internally because we know it's a unique buying opportunity because we've been around the block and we've seen different market cycles and different opportunities. This is not something that won't last, and it's really important to act on it because once the inventory is gone and once rates, continue to lower and it's a buyer or it's a seller's market and there's more competition among buyers, like these things will not be around. But I think where it gets really creative, Adam, is where you can pair this with creative financing options. For example, if you haven't heard of some of the credit unions that we've partnered with that will offer low down payment options, like you can be into properties for no money down. You can even get money back at closing after buying a property for no money down. So if you qualify, there's lenders out there that will offer a 5% down payment on investment properties, and they will actually finance you on up to 5 investment properties per person with as little as 5% down. Now, let's say you pair that with one of these investment properties where you get 10% back at closing. Not only is that going to cover a lot of your closing costs and your 5% down payment, you're likely putting money back in your pocket and being able to acquire an asset. So if you're someone like us who really takes advantage of the tax benefits and does things like accelerated depreciation, and you just start combining all of these incentives, it can be extremely strategic, right? With literally no money out of your pocket, you can acquire some quality assets that you get tremendous tax benefits on that will appreciate over time. And it just allows you to strategically grow your portfolio. And there's a lot of different things to understand about this. So obviously speak to your rent-to-retirement investment strategist to fully understand all the different options and how this would potentially apply to you. But there's just a lot of unique things right now. So that's my take on it, Adam.
So, I want people to fully understand the construction side. And that is that we talk about interest. A lot of people talk about interest rates being high, and they're talking about, 6.5%, 7.5%. What people need to understand is these construction loans are 12, 15, 18% a month. And if they have to refinance, you're talking tens of thousands of dollars to refinance.
For the builders, you're talking about the builders
for the builders.
Loans. Yeah.
So when you're saying, why are they incentivized to do this? Because these carrying costs that we're talking about are real. And so just because they're willing to give you 5-10% back doesn't mean it's a bad property, right? It doesn't mean, oh, these properties are bad, they're just trying to get rid of them. What it means is these properties are done in a time that's not the best time for the builder, and they would rather give you incentives than have to spend more than that to keep the properties in their own pocket whenever their goal eventually is to sell them to retail buyers, right? And so you're just, essentially, it's your timing is right, right? Like you'd look at when's the best time to buy 20 years ago, the next best time is today. Well, today is one of those days that you're actually in the driver's seat more than it could be. So if someone's offering you, you're like, oh, I'm getting $20,000 back when I close. Well, what's wrong with it? It's not what's wrong with the property. It's what's wrong for the builder is that they have to get out of this. And so take advantage of that part while you can. And obviously still look at the market, look at the rental, situation in that market. And we have in these markets and seen that it's good, but obviously do your own due diligence and all of that. But that's really where this is coming from, is don't think of this as, well, they're giving me money, so obviously, it's a bad area and it's a bad time for that, and they're just trying to get rid of it. They are trying to get rid of it because it's too expensive for them to carry, but that doesn't necessarily mean, it's a bad place or a bad investment for you. So that's an important thing to keep in mind, is you think 7% is high. They're looking at 12, 15, 18%.
That's a huge misconception, is people immediately think, well, if I'm, what's wrong with the area or the property if they're unable to sell it? And you just need to understand the global economic picture. A lot of these builders, they started builds 12, 18, sometimes 24 months ago in anticipation to sell to a retail market that doesn't exist today like it did previously, meaning sales for all real estate really is taking longer than expected. The average days on market is significantly longer today than it was, over the past anywhere from 2 to 5 years. And so that just means that their carrying costs are higher. That's a really good point, Adam. But as we always encourage people to understand the due diligence. I mean, this is not just like one select group of properties. There's multiple opportunities in multiple different markets, and these are growing markets. I mean, these are areas like Tuscaloosa, Birmingham, Huntsville. We just presented on Birmingham as being one of the hottest markets on a podcast yesterday we did. These are areas all throughout the state of Florida and Texas. So in the Carolinas, there's some really unique opportunities in really growing markets in large metro areas that will be well positioned to have strong appreciation both in rents and home prices, in the next 5 to 10 years. And so if you can start off your investment with putting less money down on that property, having some immediate equity, I mean, it's just going to catapult you in to the next 3 to 5 years where you're just going to be in such a better position, and you're going to be so happy that you took action during times like this. People all the time hear about timing the market. Guys, timing the market, and we never encourage people to time the market because we focus on fundamentals of real estate over time, investing in quality properties in good markets with good teams. That's the recipe to success, and understanding, the dynamics behind that. But if you want to try to time the market from a buying perspective, that doesn't mean waiting until interest rates are lower when everyone else jumps in and a bunch of the retail buyers that are trying to buy their primary residence are also jumping in, and it's more competitive as a buyer. That's not timing the market. Timing the market is making strategic decisions when the rest of the country is not taking action and not doing anything because it's a challenging time for them to have an affordable house. This is, technically speaking, a time where you can be a little bit more strategic to actually time the market and create a better opportunity. I just want to run through some numbers, though. On average, I mean, we have some new construction inventory that's as low as, the high 100,000s, 180, 190,000, low 200,000s. I think most of the inventory in the Southeast, which are growth markets, are in that 250 to 320 range on average. Your 3-4 bedroom single family house, again, many of them are already rented. So if you want to eliminate the variance post closing of when the property is going to be rented, look at inventory that's already rented. We have a ton of those. But if you look at a $300,000 house, let's say you put 5% down on that property. Okay, so that would be $15,000. Let's say you pair that with getting a 10% kickback at closing. So that's where you get $30,000 back at closing. Now, some of that may be absorbed with some closing costs. And of course, half of it is going to cover your down payment if you're using one of these 5% down loans. So that means you can buy a $300,000 property with, actually receiving probably $10,000 or more back in your pocket. That's covering your 5% down payment and closing costs. Let's say you run a cost segregation on that study. or a cost segregation study on that property to take accelerated depreciation. So this means you acquire asset that's worth $300,000. You could have some immediate equity into it. Usually we see about 30 to 35% in your accelerated depreciation on new construction. There's a benefit to new construction because you can accelerate the depreciation more on those. And this is the exact strategy that I employ every single year to dramatically reduce our tax liability. So we'll just call it for even purposes $100,000. That's right at 33%. This year it's 60% bonus depreciation, which you can still take in year one. So that would be about $60,000 that you actually reduce your tax liability if you're taking accelerated depreciation. And remember, we've covered that extensively. There's different ways you can do that with real estate professional or a short-term rental if you're not RE Pro. We have plenty of people doing this. Speak to your rep. Let us walk you through that. But just conceptualize that for a minute. You buy a $300,000 property, which is a quality new construction home in a growing area that virtually, if you use one of these creative loan options, you're buying for no money down. You're actually getting $10,000 roughly back in your pocket from buying that $300,000 property. So you're no money into it. You receive money back. And if you run the accelerated depreciation, you get roughly $60,000 that immediately reduces your tax liability, right? So if you earn $200,000 that year, now your tax liability is down to $140,000 because it comes off the top, right? Your top tier on your tax bracket. You've reduced your tax liability significantly. That could save you $20,000, $30,000 of actual money that you would otherwise pay in taxes. You add that to the money that you get back at closing as part of that 10% credit. You could be upwards of $40,000 that you otherwise would not have between tax benefits. And so again,
you know what you can do with 40 grand? You can buy another property.
And then look at this, another, accelerated depreciation, right? This thing snowballs, but you have to start it. And now, the one caveat I'll say is if you have a 95% loan, you need to look at cash flow. It may not be positive cash flow for that property, at least year one. In growing areas where rents are going up 5 to 6% per year, you anticipate it to be positive cash flow at some point, and you can always refi again. But I mean, the point is that that's not the strategy. Like, you're trying to acquire more assets. If you own $1 million worth of real estate and it's going up 5% per year, you're earning $50,000 just in appreciation per year. I mean, so these are things you need to really be forward thinking in the next 5 to 10 years. Really exciting opportunities, guys. Obviously, you can tell that we're passionate about this because these are unique things with creative financing options, with builder incentives that likely are not going to be here in 3 to 6 months as we move back into a seller's market as interest rates come down and more people enter the market. So cut me off here, Adam. I could go on all day.
Yeah. So I just wanted to, a lot of people who are listening to us who haven't invested in real estate, they have invested in stocks, right? And what is the phrase that you hear? It's not the kindest phrase. It's not the prettiest phrase, but it's always, when do you buy? You buy when there's blood in the streets, right? But the hardest time to buy is when there's blood in the streets because you're just freaking out about it. This is one of those times in real estate where there is a semi situation where there is blood in the streets for opportunities. So it's one of those things, like, you look back and you think, man, I should have invested in the stock market back in 2000 after the crash, or I should have bought real estate back in 06 or 08 after the when the values were so low. This is another time where there's a little bit of blood in the street. Take advantage of it so that whenever you look back on your investing in 5, 10, 15, 20 years, you're not questioning yourself about, man, I bought that property a year later for $40,000 more than it was that day. I got a lower interest rate. That's not something you're going to be happy about. So that's my 2 cents on that.
We interview a lot of very successful investors on our podcast that have been in this game for a long time. And, selfishly, I like speaking to them to just learn from their experiences, right? The more people we can network with and speak to, just the more sophisticated and savvy and successful we're ultimately going to be, because we're, gathering all these data points and interviewing all these really long-term successful investors. And, the kind of the common themes that we see is that people, they consistently invest regardless of the market cycle. There's always opportunity to be found. And they have a long-term outlook. They're not people that are trying to just base their decisions around interest rates or whatever. And when they see an opportunity, they seize it. Simply put, they maximize their tax benefits and they reinvest their equity and they consistently invest over time and they jump on opportunity when they see it. So this is kind of one of those things. I mean, a lot of people talked about a market crash during COVID. That didn't happen. A lot of people talk about market crash now with interest rates that have been elevated for over 2 years. We were going on 2.5 years with having, we had in 2 years ago in 2022, spring 2022, we had the highest increase in interest rate we've had over 40 years prior to that. The most dramatic increase in interest rates. People anticipated a crash. Well, we know that supply and demand, basic economics, there was a shortage of housing. There's a shortage of buying, but there's also a shortage of housing and inventory shortage. So, we did see a crash there. So, we still have an inventory shortage. And we will likely see more buyers entering the market. So that's only going to drive prices up again. But there's a lot of variables out there and a lot of concerns. Well, what if the market does this or what if the market does that? Look, invest for fundamentals. Invest in areas that have an undersupply of housing, that have a high demand for both sales and rents because a population is growing in that area. Invest below the median house price point, right? Don't go out and buy $1 million luxury house right now because that could have fluctuation more so than your bread and butter housing solutions below that $400,000 price point. That's the sweet spot where you want to be in residential real estate, especially single family, where, we see more families moving to single family residencies, especially in some of these secondary markets. That's where it's just your bread and butter housing, right? You're providing a housing solution that's in demand. As long as you can keep that thing rented over a long period of time, that house will go up in value. Either the tenant will pay the loan down. You're leveraging, the buying opportunity that you have right now. And that's how you mitigate risk. Everything has risk. Inaction has risk. All investing actually has absolute risk to it, but you mitigate your risk by understanding real estate fundamentals, investing in these areas where there's an undersupply and a high demand, and serving a human necessity, which is housing, and really positioning yourself to be a long-term investor. That is how you mitigate your risk in real estate, and that's how people build consistent wealth over time.
Absolutely. I don't think we can say it any better than that. So what I'm going to say is what you need to do is head on over to renttoretirement.com, set up a time to talk with one of our strategists, take a look at the inventory there, take a look at the incentives that are being offered there. Like Zach said, we have a lot of stuff that's already rented. We have stuff that is not rented, but, ready to go as soon as you close with the management team lined up in place for you. And so just head on over to Rent to Retirement and check that out. And don't forget, if you have any questions or topics you want us to answer in future episodes, email podcast@renttoretirement.com. That's podcast@renttoretirement.com. Really appreciate the time you spent educating yourselves. And for the love of all that's good, go out and take action. Talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.